Hey there, fellow investors. Before we dive into today's topic, let me tell you a quick story about my friend Alex. Alex was feeling pretty proud of himself. He just invested a chunk of his savings into the hottest tech stock everyone was talking about. The company had some flashy new product, and its stock price had been skyrocketing for weeks. Alex was sure he was on the fast track to riches. Fast forward 3 months, and Alex is calling me in a panic. That hot stock. It crashed hard after some less than stellar earnings reports. Alex had lost almost half of his investment, and he was kicking himself for not selling sooner. Now, we've all been there, right? Making investment decisions that seem brilliant at the time, only to watch them backfire spectacularly. The truth is, Alex fell into not just one, but several common traps that can absolutely murder your investment returns. And that's exactly what we're diving into today, the 7 things that might be killing your investment returns without you even realizing it. This is the Finance Virtuoso channel, where we talk about all things finance. If you're new here, be sure to subscribe and hit the notification bell so you don't miss out on any future money tips and tricks. 1. Falling for the anchoring trap. First up, we've got anchoring bias. This isn't just some fancy psych term, it's a real problem that can seriously mess with your investing game. As humans, we tend to latch onto the first piece of information we get about something, and then use that as our reference point for everything else. In investing, this often means getting hung up on the price you initially paid for a stock. Let's say you bought shares of TechCo at $100. The stock drops to $80, but you're convinced it'll bounce back to your anchor price. So you hold on, even as the fundamentals change and it becomes clear this puppy isn't going anywhere but down. The fix? Force yourself to reassess your investments regularly, pretending you're looking at them for the first time. Ask yourself, would I buy it today at this price if I didn't already own this? If the answer's no, it might be time to cut your losses and move on. 2. Confirmation bias, your portfolio's worst enemy. Next up is confirmation bias. We humans love to be right. So much so that we'll go out of our way to find information that supports what we already believe, while conveniently ignoring anything that contradicts us. In investing, this can lead to some seriously skewed decision-making. You might only read bullish articles about a stock you own, or dismiss negative news as temporary setbacks. Meanwhile, you could be missing major red flags that should have you running for the hills. To combat this, make it a habit to actively seek out opposing viewpoints. If you're feeling really bullish on a stock, challenge yourself to find and seriously consider the bear case. It might be uncomfortable, but it'll lead to more balanced and informed decisions. 3. The siren song of trend chasing. Trend chasing. It's so tempting, isn't it? You see Bitcoin or some hot tech stock shooting to the moon, and suddenly FOMO kicks in hard. I'll miss out on all those sweet gains if I don't get in now. Here's the problem: by the time something becomes a widely recognized trend, you're probably already too late to the party. The early adopters have reaped the big rewards, and you're left buying at inflated prices, right before the bubble bursts. Remember, past performance doesn't guarantee future results. Instead of chasing the latest fad, focus on building a diversified portfolio aligned with your long-term goals. Boring? Maybe. But it's a much more reliable path to wealth. 4. Loss aversion, when playing it safe backfires. Loss aversion is a quirk of human psychology where we feel the pain of losses more intensely than the pleasure of equivalent gains. In investing, this can lead to some seriously counterproductive behavior. You might avoid the stock market altogether, missing out on long-term growth potential. Sell winning investments too early to lock in gains. Hold on to losing investments way too long, hoping they'll recover. The key here is to reframe how you think about risk. Yes, the stock market can be volatile in the short term. But historically, it's been one of the most reliable ways to build wealth over the long haul. Don't let the fear of temporary paper losses keep you from reaching your financial goals. 5. Overconfidence, the silent portfolio killer. I get it. You've done your research, you've had a few wins, and suddenly you're feeling like the next Warren Buffett. But overconfidence in investing can lead to some seriously costly mistakes. You might take on way too much risk. Ignore warning signs about your investments. Trade too frequently, racking up fees and taxes. Remember, even the pros get it wrong sometimes. Stay humble, diversify your portfolio, and never stop learning. The market has a way of humbling even the cockiest investors. 6. Neglecting your financial education. This one might not be a psychological bias per se, but it's a huge factor holding back many investors. The world of finance can seem overwhelming, so it's tempting to just throw money into a 401k and call it a day. But here's the thing, the more you understand about investing, the better equipped you'll be to make smart decisions and avoid costly mistakes. You don't need to become a full-blown finance nerd, unless you want to, but committing to ongoing learning can seriously boost your returns over time. Read books, listen to podcasts, take an online course, whatever works for you. Just make financial education a priority. 7. Letting emotions drive the wheel. Last but definitely not least, we've got to talk about emotional investing. The stock market can be a roller coaster, and it's all too easy to let fear and greed take control. When markets are booming, you might be tempted to throw caution to the wind and go all in. When things crash, panic can set in and you might sell everything at the worst possible time. The fix? Have a solid investment plan and stick to it. Decide on your asset allocation based on your goals and risk tolerance, then rebalance regularly. This takes emotion out of the equation and keeps you on track for the long haul. So there you have it, folks, 7 major pitfalls that could be dragging down your investment returns. The good news? Now that you're aware of these biases and behaviors, you can take steps to overcome them. Remember, successful investing isn't about making perfect decisions all the time. It's about having a solid strategy, staying disciplined, and continually working to improve your knowledge and decision-making process. Before we wrap up, I want to hear from you. Have you fallen victim to any of these investing traps? How did you overcome them? Drop a comment below. And hey, if you found this video helpful, don't forget to smash that like button and subscribe for more investing insights. Until next time, happy investing, and remember, stay curious, stay humble, and keep growing that portfolio.